Well, good afternoon, everybody. I am very excited, as usual, for the next guest that I have on. And there's a lot to talk about in the market right now with interest rates and inflation, cap rates, also the big acquisition that just happened yesterday or was announced yesterday with Prologis acquiring Duke Realty for the tune of $26 billion. So there's a lot to explore about the industrial real estate market. And my guest is going to offer some great insight on this. Eli Randel is the Chief Strategy Officer of CREXi, and CREXi is a website I often mention on my channel as a great resource for people that are looking for listings in their area. And Eli, I've got to read a number of Eli's articles, and he's got some fascinating insights into this. So very excited to bring on Eli. Wyatt, if you can bring on Eli. Eli, thanks so much for joining me.
Chad, thanks. Thanks for having me.
Yeah, I'm excited for this. You got a coffee, so you're revved up.
I got my coffee, and I got to confess to the audience, I didn't know whether I should shave or not. And then I thought, I got to keep up with the commercial real estate Wolverine. So I knew I was in safe company with a little scruff.
Oh, I've had permanent scruff for probably my entire career, actually, in industrial real estate. And I saw a funny joke on Twitter the other day about industrial brokers, and it said that every industrial broker has a Traeger smoker and a goatee. And I thought, well, I've got the Traeger smoker, so if I just trim off some of the beard, I'm actually fitting right in with the rest of the industrial guys.
I like it. We'll have to try it out for the next episode.
We'll smoke some meat and grow goatees for it. It'll just be us. Maybe there's an idea for a show there. We'd have to come up with a catchy name, but I'm sure we could think of something.
I'm in. Sounds good to me.
Love it. So let's talk about this big acquisition. It came out that they were negotiating privately for several months before. They came out about a month ago, and I think at the time it was $24 billion that they offered for Duke, and Duke said it was insufficient. Comes out yesterday that they've reached an agreement at $26 billion for the acquisition. Massive acquisition. I believe it's 160 or 165 million square feet. What's your take on that? Like, what's going on to have them pay such a big premium for industrial real estate in this kind of volatile market?
Well, I have to confess, I know little about the deal in terms of the actual economics, what the average cap rate or yield looked like and what the financial implications were. But industrial real estate's obviously a hot product type right now, and rightly so, given a lot of macro trends taking form. And I think Prologis is just trying to gobble up as much of it as they can. It's a great company. I do have to confess I own a very teeny amount of Prologis stock, but I've been big fans of the company ever since they merged with AMB, which is a predecessor I had done some business with years ago. And they've got a great management team. They're a very savvy company. So I'll take to believe that it was a smart move, but I also preface that I haven't really dug into it too much.
Yeah, and I'm not. I also did own some Prologis, but I sold it recently. I just thought that there were some headwinds in the market, and the yield on it was pretty low, so I was just a little skeptical on it. Kind of got lucky on it. I certainly didn't expect it to drop 25% or whatever it has from its high, but I certainly got lucky on it. But I guess that speaks to some of these trends that we're seeing in the industrial real estate space right now. The last 2 years, we've seen this massive ramp up, which largely driven by e-commerce and just the system that needs to have that warehouse space added in there. Where do you see we are right now with, and we'll get to interest rates and inflation and cap rates, but where do you see the market right now from like a macro level?
So I think from a smaller picture, it's possible that even industrial isn't immune to some headwinds, just given cost of financing and some other things we'll talk about. Even though commercial real estate is a great hedge against inflation, I think it's well suited to combat some of those forces. It's a tricky environment out there. So near term, I'm not entirely sure. Long term, I think these are all multi-generational plays that are savvy, and we'll look back in 20 years and look at some of these companies who really made a strong presence and took a big chunk of industrial real estate, and they'll look pretty smart.
What do you say to the non-institutional investor, the guy that's perhaps owns one industrial property or he wants to own one industrial property? What do you say to that guy?
I would say to that guy or gal, if they can institutionalize that property and perhaps add others to it, package it, and sell to an institution for a premium, that sounds like a pretty good business.
What happens if they want to just actually have it as cash flow? Do you try to time the market, like, and with all these factors that we have affecting everybody right now? Do you try to time the market, or is it just a matter, like you said, of ignoring these aberrations in the short term and try to think more long term?
I think if they're multi-generational and they can take a big picture view, which is in part result of the financing they may get to acquire the asset, then they'll be money good and it could be a very successful strategy for them. I think if they're an entrepreneur and perhaps not entirely in tune with operating industrial real estate, they can probably do something elsewhere. I mean, some of the yields are pretty compressed. So if their emphasis is cash flow, I'm not sure it's the best product type for them. It's also a little, I don't want to overstate it, esoteric and can be operationally intensive at times. So if it's a new entry into the space and a new product type for them and they don't have deep experience, it might not be the right play, but pending their strategy and their timeline and their experience level, I would support an investment like that on an individual basis for sure.
Yeah, that's really interesting you say that, and I echo those comments. I think industrial real estate should actually scare the first time investor, because there are pitfalls and there's things that can go wrong. So having a game plan and understanding what you're investing in and knowing what your downside risk is just as important as trying to forecast what your potential yield would be. What do you see industrial comparatively to other asset classes like office, retail, multifamily? How do you see industrial right now positioned in this market?
That's a great question. I think in the context of what we've been discussing, it's probably front of the pack, pound for pound, long-term potential, current yield, tight market conditions. However, it's not a passive investment. So there might be a strategy like retail where you could get a single tenant net lease or something more passive, a yield that still hopefully well exceeds long-term bonds, and other features and benefits that may make it a more attractive investment for some. I think it's a tough question to answer without understanding the investor's experience level, timeline, appetite for risk, appetite for operating the property. Hard question to answer, but there are a lot of wins behind industrial real estate that make it really attractive, all things equal.
Yeah, and I appreciate that. That's a very difficult question to answer, but so perhaps I'll even narrow in on it a little bit more, because I am curious to get your take on the retail and the office market. So retail more specifically, there's indications that brick and mortar retail asset class has actually seen a little bit of growth, and they've been beaten down and had so much market share eroded over the past 20 years that it's any increase is still trying to claw back all the losses that they had. But do you see retail being an opportunity for someone with, and I appreciate that it's everyone's going to be a little bit different, but more thinking from just that cursory standpoint of somebody looking to consider commercial real estate, what do you see the outlook on retail right now for that brick and mortar space?
I'm still a bull, and I'm a little bit of a contrarian by nature. So when people were doom and gloom on e-commerce displacing brick and mortar of relevance and importance, and really consuming all the sales digitally versus in a more brick and mortar fashion, I was still kind of bullish. My understanding, I don't have the exact numbers, is e-commerce is still, call it about 10% of total retail sales. It's growing fast, but that means most business is still being done in brick and mortar.
Mm-hmm.
I would also add most direct-to-consumer brands or e-commerce plays are looking for brick and mortar strategies I call click and mortar. So they are intertwining them. It is remaining relevant. And then just last, and this is a little more anecdotal, when I go to nice centers or go to the grocery store, I'm having a hard time finding a parking spot. So I don't really buy this headline that brick and mortar is challenged right now. It's changing, it's transitioning. There are trends worth paying attention to, but I'm still pretty bullish on retail's product type, obviously, depending on the property and the market and some other conditions.
Yeah, well said. And I love that term, clicks and mortar. I'm using that. I'm stealing that off you. That's a great term. Okay, so let's explore that a little bit more, because I on the other side of that is the all this e-commerce space that has popped up, all this warehouse space that's popped up to service the e-commerce. And Amazon reported last quarter that they had a 3% decline in e-commerce sales. That's only one company, but it's the largest company. So I'd have to assume that that has permeated the rest of the industry to some extent. Maybe not at the same level, but these large increases in growth have at least temporarily stalled. Do you see that affecting the future warehouse space? It's a big machine. It takes a long time to start and stop. But if e-commerce sales stall, and this is a trend going forward, do you think there's a risk of overbuilding warehouse space?
I don't personally believe so. I don't have much data or analysis behind that opinion. I think 3% and the numbers we're talking about, I don't want to call it small because I'm sure numerically it looks really large, but when considering last year was still a closure environment given COVID, there could be some noise in that stat. And I do think there are some economic forces probably also pushing that down a little bit as well. I don't think there's an oversupply of industrial real estate right now. I would agree that if all of a sudden Amazon and other logistics and distribution players start closing, there would probably be a hyper supply and an oversupply, but I don't personally envision that happening.
Yeah, by all accounts, there's still a lot of money flowing into that system. Where I'd personally see a little bit of a risk is that, like that there's that economic pie of consumer spending, and a sliver of it's going to e-commerce, like you said, somewhere in that 10% range, and then bricks and mortar has the rest. That pie is kind of a zero sum game. If e-commerce takes some of that pie away, then there's only that much left for bricks and mortar. The other risk that I see is the pie just shrinking, and that's where we could potentially get into a recessionary environment, and then the pie shrinks, and then by very nature of everybody having less money to spend, everybody's positional share shrinks. So I do. That's like the main topic that I really wanted to get your thoughts on. It was interest rates, inflation, and cap rates. But I still just want to circle back to one more point about office, because I think I'm not an expert in the office space by any means, but I do want to get your thoughts on this work from home shift, whether you're seeing trends that this is going to be more permanent, systemic, or whether there is going to be an attraction to get back to the office. And I know that that's not necessarily related to the industrial market, but to some extent it is, because there's a lot of industrial zone properties that are built out as predominantly office space. So even though it's a distinct asset class, I do think that there's some overlap. So long-winded question, but where do you see in the office space right now?
So it's not a popular opinion, or it might not be. And it's easy to say the one that everybody wants to hear and get clicks and look like a hero. But I think a lot of companies are realizing productivity and also speed suffer from the pure work from home environment. What once could take 5 minutes, walking over to a colleague saying, "Hey, I've got a great idea. You want to go for a quick walk?" and socialize it, or bouncing off ideas off each other, collaboration, spontaneity are down. That could be a quick 5 minute, just ad hoc conversation. And now it might be a week of scheduling a Zoom call. So I think the answer is somewhere in the middle. I think office environment is important. There's also an element of mentorship. And it may not pertain to all industries, but I know in banking, for instance, if you're a young investment banker, it's almost a tradition to learn at the side of someone who's been there before, and you can't do that remotely necessarily or as well, in my opinion. So I'm a believer that as some data comes back, most big major office occupiers are going to realize they need to keep their space. Now, do they change the footprint? Do they decentralize and open multiple locations in case one specific market closes? Maybe. It's not to say everything will be status quo, but I don't think corporations are leaving an office environment. I do think there are macro conditions I know we'll get into, which may hurt job growth and may actually reverse job growth, and that'll affect office. So it's a little topsy-turvy, probably depends on the property type, the tenancy base, the market, and conditions like that. But at the risk of sounding like a permabull, I'm not of the mindset that the sky is falling. And if I'm an office investor, that, my craft is going to disappear. I don't believe that personally.
Yeah, I echo those comments. There certainly are pressures because there's a large segment of the workforce that just doesn't want to return to the office, and I can certainly appreciate why they don't. They don't have the commute, they don't have the extra hassle. They don't even need to wear pants. So there are some upsides if they just want to work from home. And again, I'm not an office expert. I'm just looking at this purely through my own lens, but I would think that there's two reasons why people would want to consider going back to the office. And the first being, if you're trying to advance in the company, trying to get a promotion or trying to just move up in the company in general, you've got a much better chance if you're getting that face-to-face time with management or your supervisor, where you're interacting with them more than someone that you only interact with by a computer screen. This technology that we're even using right now is certainly helpful, but it doesn't take the place of you and I having a coffee in North Carolina. That'd be a much different experience. So I would think that anybody that does want to move up or advance in the company should be in the office. And then the other thing, which is probably a little bit of a contentious position to take, but it's just something that I believe, is that if you work at home all the time and you don't need to go into the office, then your job is expendable, and it's also at risk of perhaps even getting offshored. Like if you could do your job solely at home, why can't somebody in overseas do that for a fraction of the cost if it's all by computer screen as well? So I think that that's kind of like the spectrum there is you're at risk of not getting promoted or advanced, and even more great, you're at risk of your job just being xed all away. I've just canceled.
I just want to add two elements to that. One, and again, this is anecdotal. There's a lot of narrative that employees don't necessarily want to go back into the office. And, I'm ears wide open, and that makes sense to me. And I think there are dynamics that could benefit from change. But there's also a lot of overlapping narrative that some of this young workforce is kind of feeling lonely and feeling like they don't have structure and their social networks are disintegrating. So I think it's a temptation that sometimes disservices the young professional. It feels like the right thing, and in many ways it can be. There are those days where you need it. You need a break, a change of scenery, or you're multitasking and doing some things at home or other. But I think often maybe some of the dissatisfaction in some of these people is stemmed in having lost some of that camaraderie and some of that team dynamic and being a part of something and having a social fabric. So I'm mindful of that as well. And then the last element I'd add is the last couple of years, it's been a shortage of skilled workers and the employee, other than comp. And I think a lot of people are under-comped, but for the most part, the employees have had a loud voice as people begin to get laid off more and more, and it becomes a competitive job environment, and perhaps people's savings start to erode or suffer with some of the losses in whatever investment vehicle they're in, stocks or crypto or whatever. They may not have that same voice or ability in those conversations to say, no, I want to stay at home. If the employer says his office-only job, the tone might change a little bit. And that's not to say, again, I am supportive of work from home dynamics, but I don't think it's either or all or nothing, in my opinion.
Yeah, that's very well said, and great points on that. And like going back, I'm sure you've seen these headlines over the past 10 years as well, as the office is dead, or it's the retail apocalypse, or something. One industry is going to collapse all of a sudden. And I agree with everything you said there, is that you can't look at all these at these headlines in a vacuum. Like if you only looked at e-commerce sales continuing to grow at an exponential pace, then if sure, inevitably they will have 100% market share, and in that theoretical environment there would be no need for bricks and mortar. But as you said, there's still people that enjoy doing those things. They enjoy going to shopping malls, and on the work front there's people that still want to have that social camaraderie, and they want to be involved and have the synergy of people around. So the story is far from written. I would agree with you on that, is that it's not dead by any means. It's going to change and evolve on both those industries. So yeah, thanks for sharing your insights on that. I found that pretty insightful. There's a handful of questions that came in here, so I want to jump to those before we move on to interest rates, inflation, and cap rates. And if you have any other questions for Eli, please put them into the chat as well, and we'll try to get to as many as we can. Warehouse investor, thanks for joining in the question. What will rise in interest rates do to cap rates? We'll get to that. That's going to be a good conversation to have. Yakov, thanks for joining in. What about ground up developments? Would you see this as a great time to kick off a project? Great question, Yakov. Eli, what do you think?
Well, I hope I came across a little bit that I'm more of a generalist and I've been less specific to, any one segment in recent years. So I say this as a little bit of a generalist. It's a hard question to answer. I think if it pencils out, if it's an underserved market and you can get the appropriate financing and it times out where you think you're going to deliver in a environment where your product will be in demand, I think in many ways it could be. I'd also be mindful of what you expect to sell that project for. If it's a build to own project, maybe you can hold it for longer and time out the best exit. If it's meant to be sold at delivery, you could be facing a different cap rate environment, which would certainly hurt values. So I don't mean to be evasive in any sense, but without knowing this specific project, it's a hard question to answer. Projects will still get built, in my opinion. Good projects by good sponsors and good markets. So from that lens, I don't see why not. But obviously, the room for failure, the margin of errors probably tighten some.
Yeah, and to add on to that, my thoughts, Eli, I think that you might just want to adjust that sensitivity analysis that you're doing in there. So if you're doing like a worst case, best case, and a normal case scenario, you might want to lengthen that worst case scenario. So what would that property be worth on a lease basis? What's ultimately going to drive the underlying value of the asset anyways? What would that lease for if you had to compete with the existing market? And maybe that existing market has a little bit of downward pressure on it if we go into a recessionary environment. So maybe you just have to adjust your worst case scenario numbers down. And maybe if you were pro forma at $8 a square foot, maybe you're now looking at it being $6. Maybe that's like your worst case scenario. And if you can still justify your worst case scenario and know that recession might last 12 to 24 months if we go into one, and you can still justify that, I agree with what you said, Eli. There's still projects that are going to be built. There's still developers that were committing the plans even right as we went into COVID there. So there'll always be projects. There'll always be a business case to do it. But you might just want to tighten down your numbers and like you said, just be more cognizant of the risk that comes with that. But a great question. I saw a couple more in there, Wyatt, if you could pull those up as well.
Yeah, Chad, it's kind of a conversation that's going back between some people. So I'll bring them up and you can read them as a conversation.
Okay,
all right?
Perfect. Okay. Kyra, thanks for joining in. Amazon out here in Puget Sound is internally reporting that they think they've completed their investment in logistics, that they had a 5-year plan for expansion, which they discharged by end of year 21. Yeah, I think that speaks a lot to what Amazon reported, that they've essentially hit their max amount of warehouse space for right now. What's interesting though, and this is another topic that just gets lost in the headlines, is that Amazon has basically said that they only want to do short-term subleases in some of the markets where they committed a lot of space. So they added a ton of inventory over the last 2 years. And what they basically said is that some of the space, they're like to do short-term leases on it in anticipation of perhaps needing that again. So it was completely blown out of proportion that Amazon was going to do this, but that makes big news. What's your take on when you hear the largest user of warehouse space saying that they need to dispose of or temporarily sublease some of their space?
Well, it's interesting. I didn't realize that, and I hope I prefaced everything by saying I didn't have all the details behind every item, but I'd probably want to go back and rethink my answer a little bit. It's definitely worth paying attention to and worth noting, but I'd also want to poke and prod and find out why and look for opposing views. Perhaps there's a reason, or they had a strategy around doing something and then they'll recommence at a certain time. I don't know the answer. I don't want to comment too much without doing my own homework, but it's certainly worth paying attention to. My suspicion is there are probably still some other industrial occupiers who are under their space needs. So hopefully that lack of growth will be offset by some others, but worth noting for sure.
Yeah, I always go back to a study that NAREIT put out, I believe it was in 2018, and they mentioned that the aggregate size of the industrial market in the US is about 20 billion square feet. So if you take that, and Amazon said that they were going to try to sublease anywhere between 10 and 30 million square feet. If you take that amount of space that they're looking to sublease and even use 4-year-old data, which the market has certainly increased since then, the amount of space that they have is like a fraction of 1%. I think it's like 0.01% of the total amount of inventory that Amazon's thinking of subleasing. And that's after they added a staggering amount of real estate over the last 2 years anyways. So it'll be interesting to see if that trend does catch on with other e-commerce companies. But as of right now, I don't think that that's a panic button by any means.
I'm slightly dubious that other occupiers were as aggressive as Amazon. So there's probably still some catching up to do from others. Amazon also has a unique position in that maybe once upon a time they would have warehoused to some degree some of that shipping and last mile transacting probably takes place at Whole Foods and other establishments like that. So it's possible there's some noise in there, but again, I appreciate that comment. It's really good insight worth taking note of.
Yeah. So let's transition over to the hot topic, the topic du jour with interest rates. And I believe the Feds are meeting tomorrow. And I've read something in the Wall Street Journal that they're now even thinking there could be 75 basis point increase in rates. What are you seeing on the interest rate front?
Yeah, last disclaimer, I'll just note I'm not an economist. I do pay attention to this. I did study finance for several years, and I am in tune with a lot of this stuff, but I am not professing to be an economist. So I just want to get that out there. But I'm sorry, I forgot the question with my little disclaimer.
Well, the disclaimer is important. I'm a lot of things, but I'm certainly not an economist either. Most of the things that I am are probably not, I probably can't even mention on a live show, but I'm not an economist either. So I appreciate the disclosure. On interest rates, so I think the Feds meet tomorrow. I believe it's the 15th, or it could even be today. There's a rumor that they could actually increase the proposed interest rate of 50 basis points. We might even see 75 basis points because the inflation numbers last month were 8.5%. So what do you think on that interest rate front? Where do you see that headed in the short term? Where do you see that headed in 2022?
So I think I can't predict whether it's 50 bips or 75, but I think to cool inflation and cool the markets, there will certainly be more increases, and rightly so. I have this weird sneaking suspicion, and again, I'm not an economist, that perhaps post next election cycle, you may have a president or a presidential candidate who somehow is forceful in trying to influence the central bank to start lowering them again. So long term, who knows? Because there is political pressure. Short term, I think we're going to continue to see hikes. And I think it's justified, and especially with the most recent inflation numbers, which I believe exclude some categories they probably shouldn't. So long way of saying they may even be a little understated.
Do you see more upward pressure on that than just for the taming inflation and the political pressure that you're seeing? Like, do you see this going multiple increases in 2022? And again, we're just guessing at this point, but what's your guess?
I would suspect this won't be the last of it. Maybe if it's 75 bips, it's more likely that there's not going to be much more activity, but at only 50 bips, I would suspect it's not the last increase for the year.
Yeah, that's a great point on that. And if you taking that into account, would you be fixing debt or would you be floating it right now?
Great question. I hadn't thought of in advance. I'm trying to tinker through it in my mind. I would personally rather be in fixed debt because with value erosion, also the erosion of debt. So if I owe $1 million and the dollar is depreciating due to inflation, then that $1 million is also starting to erode. So I actually think it's attractive in some ways to have some responsible debt because that also erodes with inflation.
Yeah, that's an interesting point on that. So let's get into that relationship also with interest rates and cap rates. And there appears to be a decoupling of that right now in the fact that interest rates are rising, but we haven't seen cap rates rise accordingly, or at least lockstep. So where do you see cap rates right now? And actually, maybe even just to frame that, like where do you see cap rates pre these increases? There's obviously been some downward pressure on cap rates. Where do you see that market right now, and where do you see it going for cap rates if interest rates do rise as we're expecting?
So cap rates have, as everybody listening, I'm sure would agree, or I think would agree, been compressed for the last few years, and very compressed, one could argue. But alternative investments didn't really offer much attractive yield. And as you know, investment vehicles like equities have been a little volatile and choppy. So sometimes those compressed yields, especially when modeling rental rate appreciation and some other factors, they weren't discouraging too much to me. I think as interest rates increase, you're going to see cost of capital also increase with it. There might be this lag period, as we may be experiencing now, where spreads tighten versus rates changing significantly, maybe not in real time. Additionally, I think there's so much pent-up capital seeking placement right now that perhaps there's a lot of cash buyers still chasing yield. And some of these yields, in many ways, are still relatively attractive when considering other options. So if you can get 5, 6, 7% yield in what you deem is a pretty safe investment, perhaps you buy cash, assuming you're capable of doing that, or a little bit of a lower leverage profile. I just think there's been so much pent-up capital seeking placement and chasing good deals that it's kind of kept values propped up, aka cap rates compressed during this time. How quickly they kind of increase or how drastically they increase, I can't say that, but I wouldn't be surprised if cap rates still stay at pretty healthy levels with asset values at pretty healthy levels still.
Yeah, I would agree, and with the caveat, of course, that it's property specific, it's market specific, everything. You do have to look at everything kind of in that narrow scope as opposed to just making a broad sweeping statement, like I certainly do all the time. It's important to still look at your local market, and look at all those nuances in your market. But from a broad picture, I still do think it's pretty important to have a global, or at least a North American wide scope on what's happening, because what happens in North Carolina is going to happen to some level in New York or in Toronto and Vancouver. There is overlap on those markets. So I do agree with you. I think we might see a little bit of upward pressure on those cap rates as interest rates rise, but the alternative is what? Doing nothing, not making an investment, leaving money in a bank and perhaps seeing it erode at the rate of inflation. Like that doesn't necessarily seem like a good alternative either. So perhaps investors do just have to accept less of a yield, but at least not be subject to seeing their money just eroded through inflation.
Yeah, and sorry to interrupt,
No,
Chad.
no,
It's
no, no
also,
problem.
a good, stable, hard asset. You can, hopefully obtain some good positive leverage. There's some inflation hedges, which sometimes get overstated, but some of them are real. So I think commercial real estate is still pretty good investment strategy during these choppy waters.
Yeah, I think is just to piggyback on what you're saying there, Eli. I think if you can get a good asset and maybe you have to accept less of a yield, or you have to accept less of a lease rate just to keep it occupied. But if it depreciates in the short term, if you've got a 5 or a 10-year hold, these aberrations on a year-to-year basis are really not as significant as just your ability to hold that asset over a long period of time, get some appreciation, hopefully get some appreciation, get some principal pay down, hopefully cash flow along the way. I still do think that is a better alternative than just sitting in a bond, a low yield bond, or sitting in cash, which could be even worse. On the inflation front, what's your guess on that? Is this 8% going to continue forward until these interest rates start pulling back economic activity?
I don't know. I don't think we're done with the inflationary environment, and that's not a profound statement. I think that's a fairly basic, easy call or easy thing to say. But I do think for a long time it's been understated. There are certain things that are measured, certain things in that CPI bucket. Whereas there are other things that I do think are inflating pretty significantly that aren't always included. So I think we'll see a little more inflation when it ends, when it tapers, when it normalizes. I can't predict it, but I don't see that right around the corner just yet.
So the textbook definition of a recession is 2 consecutive quarters of negative GDP growth. Do you see a recession this year or early 2023?
I believe we're already in one personally. I don't know if technically it's been 2 consecutive quarters. In fact, I don't think it has been, but to me, there's a slight semantic game to that, whereas it smells a little like a recession out there, in my opinion. But I also think there are things to be kind of hopeful about. I think this correction is so far seems somewhat sharp and severe, which I think is important. Speed of purging the system and righting the ship is important. That's not to say we're anywhere near done, but I think it's been pretty sharp. And I don't know, it feels like a mild recession to me. And again, that's probably not a term that's supposed to be used, but feels in many ways we're already there, but that's kind of semantics to me, I guess.
So
Not a great question. That maybe exposed my previous disclaimer.
That just goes back to my skills or lack thereof as a podcast host, is asking a question with no answer. I tend to do that actually quite a bit. I should have warned you ahead of time. But I like putting people on a little bit of a hot seat every once in a while.
You did. Yeah.
Hey, if I'm not intending to do like gotcha questions, I'm just legitimately looking to get your thoughts on it. So you mentioned there's reasons to be hopeful or reasons to be optimistic. What do you see that is encouraging for you?
I don't know. It's funny, as I said it, I was knowing you'd probably ask what those are, and I could get into it. I'll run my brain a little bit and come up with something. Just I don't know. I'm maybe, like I said, contrarian by nature. So there's probably interesting opportunities emerging. We seem to be purging the system fairly quickly. Maybe it's darkest before the dawn. I don't know. I'm coming up with cliches to, try to come up with something. I'll get back to you on that one. But my general temperament right now is, having gone through 2008 and been in ground zero for commercial real estate, this doesn't quite feel the same. The severity, the global nature of it, house of cards that was built then doesn't quite feel the same as today. That's not to say there aren't real things to be concerned about. I'm not flippant, but I don't know. I guess this is part of life. You get ups and downs, and you gotta find the stable middle ground. And maybe we're in a down period, but that forces a reaction in me to find the optimist within.
Yeah, and maybe I'll even just kind of add what reasons I think there are to be optimistic. And I agree with you completely. This feels like a recession to me, even though we might not be there in like the textbook definition of a recession. It still does feel like that. And all you need to do is open your stock account right now and see how much it's dropped in 2022 to be reminded of that. But what makes me think that this, like you said, could be smooth or one that we transition out of quickly is I've been through two big downturns. I was through the capital crunch in 2008, 2009, where that's where the entire financial system collapsed, and there was no capital. It was very difficult to finance any properties, and by extension, that was a very difficult time to be working in because there was almost stagnant. It was very difficult to do anything in that market. And then COVID, when that came on, there was 3 months where nobody even knew what was going to happen. So that was a really scary time as well. On our tenants going to be able to pay their bills, or our property owners going to be able to pay their mortgage payments. That was a really scary time too. What this reminds me of is there's still a ton of capital on the sidelines, both from the lenders who want to deploy capital as well as the investors who are sitting on a lot of cash. But we're in an environment where the feds are having to increase interest rates to fight off all this inflation. All the money that was injected into the system over the last couple of years really shouldn't be surprising to anybody that there's inflation. And the lever that the feds have to pull to try to limit this amount of inflation is interest rates. And we're still at interest rates that historically are not high, but there's that sticker shock. And anytime there's sticker shock in the market, people start reconsidering how they want to make decisions. But I think once that normalizes to some extent, I don't see the feds being in a position where they can get into double-digit interest rates or maybe 200 basis points higher. I think that there's a limit on how high they can raise those interest rates, and I think the market just needs to adjust and respond. So I'm with you on that. There's no big cataclysmic event, at least yet. Maybe that could come tomorrow. Maybe after we finish this interview, we open the news and something crazy has happened that triggers something more severe. But if it's just interest rates rising to combat inflation, I don't see this being a prolonged recession. But there are perma bears out there that think that this could be the start of something more severe.
Yeah, and I think part of it is so the party might have ended. Maybe we consumed too much alcohol. It's 3 a.m. We feel like crap. Maybe starting to spin around a little bit. But it was a pretty good party. And just anecdotally, when you mentioned the stock market, by the way, I'm not a huge stock investor. We're not talking about a lot of money. When I checked this morning, as bad as things have been, if you've been in the market for the last 2 or 3 years and were responsible and not chasing these goofy investments, you're probably still up. So I don't know. I just parties have to end at some point. I'm glad it didn't go on so long that cop showed up. I'll keep exhausting the metaphor if you want, but I don't know. I have this strange optimism. I'll have to find a way to articulate why. And by the way, that's not meant to be ignorant to so many people who are having hard times, because that matters as well. And I do think these will continue. They're not going to end tomorrow, and there's probably a little more pain yet to happen. So I know it's harder for some than others, and I'm mindful of that. But I have reasons for optimism. I'll find a way to articulate them next episode.
I love it. So we had a couple more questions come in. Wyatt, if you could pull them up. Another one from Yakov. Thanks for the other question. Talking to a bunch of industrial developers, they're spooked and sitting on the sidelines right now. Is this a time to be a contrarian or go with the crowd and duck and cover until things calm down?
Probably duck and cover a little bit, but I'd also be opportunistic. I think if you see some people overreact and perhaps they're undervaluing assets and they're looking to dispose of things or recapitalize, and I think some opportunities will emerge. But in my experience, that's a slow process. I think typically people are slow to come around to reality, and the housing market, for instance, if it softens, you're not going to see people who don't need to sell suddenly drop their pricing significantly. Usually, in my experience, that's kind of a slow grind where they go, man, I wish I could get what I could have gotten last month, and then the next month, and then they start chasing a market down a little bit versus one severe price drop. Really a long way of saying I would be contrarian in the sense that I'd keep my eyes open for opportunities, but probably best to duck and cover like the rest of people and wait for some smoke to clear, see what plays out a little bit longer.
Yeah, and depending on what stage you're in that development might guide your decision as well. If you're just in the preliminary stages of planning and perhaps you got land under contract and you're going through due diligence, then maybe it is an opportunity to just take a breath and say the market was so hot in that industrial space for 2 years with double-digit rental increases and vacancy rates in some hot markets getting below 2%. It might be an opportunity to just say, let's just take a breath and see what the next couple of months look like. Because you're right. I think that there's always an opportunity to go forward on deals, but just being prudent and making sure all your bases are covered is a responsible way of doing business too. Kyra, thanks for the question. Many industrial developers I'm working with are stepping back for now. So reiterating what Yakov has said as well, between interest rate hikes and construction costs and permit flow, people are sitting down for a quarter and taking a break. Yeah, you and I are on the exact same page, Kyra. And I think we're just kind of echoing what Eli's saying there as well. One point I want to get your thoughts on that she mentioned there, Eli's construction prices, because that's surely tied in with all this inflation that we've seen as well. Do you see construction prices either being on the hard costs of the materials or on the labor side? Do you see that starting to tame in 2022 now that we're in this new environment?
So I don't have a great answer for this based in deep experience, but I think one thing I heard is lumber prices are down. I know that pertains less to industrial, but I think there are some things that are cooling a little bit. And then I have a sneaking suspicion that GCs who are really loosely bidding contracts because they were so busy and they had so much work that they were submitting like kind of stupid, rich, juicy numbers. As they're competing for business now, as things slow down, you're probably going to see some labor costs go down. So inflation will probably push some things up a little bit, but I think some things will also come down some. I don't have a great answer there, but I've got a sneaking suspicion they'll either stay stable or even go down.
Yeah, I heard it from a developer the other day talking about lumber, and you're right, it isn't common in industrial construction, but what it does do is if lumber prices are really high, that incentivizes developers that would have used wood in other asset classes to now consider pre-insulated metal panels or whatever it is. So by extension, it makes those products go up as well. So lumber prices coming down, all of a sudden, those prices should, in theory, also put downward pressure on other building materials. So hopefully we do see some relief, because the way that construction prices were going, and I'm sure that anybody listening, regardless of where you are in the world, you've experienced a lot of upward pressure, and that makes deals less affordable. It makes deals less attractive to build out tenant improvements or do additions or expansions if the construction prices are going up. So hopefully we do see some relief from those prices as well. We've got a few minutes left here, so if anyone has any other questions, please feel free to put it in the chat. Afsal, I hope I'm saying your name right. Any thoughts on the loan defaults considering recession talks?
So I used to work for a company that was the largest special servicer at the time, at least they might still be. And really that was their business, was working out distressed debt on behalf of CMBS trusts. So I do have a little experience in that world. Um, I think a lot of projects, well, I shouldn't say projects, because if you're in the middle of something, you might be figuring things out. But a lot of seasoned commercial real estate loans are probably money good. I think there's certainly going to be an uptick in defaults and distress, but whether it's cataclysmic or significant, I can't say. My guess is it's not going to be extraordinary. It's not going to match 08 to 2010, but you'll certainly see an uptick.
I remember at the beginning of last year, beginning of 2021, I talked to a number of receivers, and the term that I heard all the time was this: they were expecting this to be the Super Bowl of receivership, of properties going into foreclosure, and they were all gearing up for this massive wave of property defaults and having to take it over and deal on behalf of the lenders. And it never came to fruition, at least not to the level that they were anticipating. I think there's always going to be some foreclosures of a company that just can't pay their debt, or an investor that can't pay his dead, and then it goes into receivership or foreclosure. I think there's always going to be an element of that, but I agree with you. I think that there's still an appetite to work with investors and companies to still navigate through this time that we're dealing with, this once in a century pandemic. It's still lingering. The effects of it are still lingering. So I think lenders, provided that there's open communication and a game plan to navigate through it, I think lenders are going to be more amenable to dealing with this than just foreclosing like they would have in 2010, where there's a lot of calamity in that market.
So I think there's also, sorry to interrupt you, Chad. I think there's also a pretty good supply, and that can always change and it can happen quick, but pretty good supply of commercial real estate debt capital. They're pretty creative, competing for investments, albeit it may get a little more scrutiny than it has the last few years, and it might be more expensive, but there's probably a lot of creative solutions for borrowers. And, I'm reminded of a time in 2017 when they thought all the 10-year loans from 2007, when there was so much activity, would just hit a wall of maturity, I think they called it. And it didn't really play out that way. So I'm not a huge believer, in market timing. Obviously, we're talking about the now more so than trying to time something out. But I don't know. I'm a little personally skeptical that it's going to be this severe, drastic downturn, at least in our space, commercial real estate.
Yeah, I completely agree with you. And I've said to people regularly that are apprehensive to make a decision that there's always reasons not to make a decision. Like, you could point to anything happening at any point in the history of mankind, and you could find a reason not to have made a decision. And right now we're faced with many of them: interest rates rising, inflation rising, recession that we're probably in already, still the war. There's still so many reasons not to make a decision. And perhaps that is the best decision, is to not make one right now and to try to time the market. But I myself, for the decisions that I made, I could have pointed to any number of reasons on why I shouldn't have done it. And for the most part, they've all actually turned out reasonably well. So I think if you're trying to time the market and you're apprehensive to make a decision, there's lots of reasons not to do it right now. But it's also very difficult to try and find when the best time is, because a year from now or 5 years from now, there's still going to be reasons on why you shouldn't do it. So just if you've got the capacity to do it, you've got an appetite for risk, you have a long-term plan in place, and you've got some contingencies, I don't know. It's I think that there's always reasons to talk yourself out of it. You need to find the reasons on why you want to talk yourself into it. Not investment advice. I'm wrong all the time. So don't take investment advice from me, but I just always believe that there's reasons to talk yourself out of it. So you need
I've
to.
seen that time and time again in my career, where the smartest guy in the room, analyst, leaves to form their own buyer shop or become the head of acquisitions. And they don't get many deals done because they're really good at finding all those reasons to stress their model and maybe overly stress their model. And it's almost big-eyed entrepreneurial visionaries with big guts who see past that and get deals done. So I think part of it's persona and how you look at the world, and knowing that problems always come up, and how you solve them might differentiate what kind of investor you are.
Exactly. And doing nothing is also a risk. There's risk that you could be eroding your cash in your bank at 8% right now. So there's always risk. It's just finding what risk you're comfortable with. I saw a good question that I think would be natural to end on from Neil White, if you could pull that up. Neil, thanks for the question. If industrial is still a good investment, what are the investments you think are more risky right now? Crypto, stocks, metals?
I could speak some to stocks. I follow the stock market a little more than I let on, but I'm still not pretending or professing to be an expert. Metals, I don't really follow. I've read enough to know the strategy and understand it, but I don't know the trends. I might get a lot of angry calls and calls from colleagues. I never liked crypto. I just never was appealing to me. Some of the bubble chasers who surrounded it, I just was always, it felt like, I don't know. I never understood a lot of the utility. I understand not all are equal, and some have utility, and others, to me, I just never found value in them. So in my opinion, I think crypto is very risky, and I don't want to say all. Perhaps there are some that are beneficial because the thesis is strong, and it seems to be a lot around an ideology, more so than greed and people who like to make money. I didn't say that quite right, because I think people in this space do like to make money, but they seem to be very ideologically focused. And I think one flaw you're seeing in crypto right now is crypto was meant to be the inflation buster, where there was a finite supply. Thus, it was a great tool to navigate inflationary conditions. It was also meant to work in many ways, not all ways, counter to the stock market. So you had a hedge against the market. And I think you're seeing none of those values really play out that way. You're seeing it really collapse under conditions many said it might thrive under. So I'll probably get a lot of angry calls from people smarter than me, but just having a nose for hating to lose money, I've always avoided it, and I'm pretty glad I have. To me, it seems risky. I don't know. I don't want to speak for every cryptocurrency, but all in all, that's the way I feel.
Yeah, I'm on the same page with you, Eli. I had some crypto earlier this year, and I sold it all. I have zero crypto right now, from the standpoint that I don't understand it, and I'm just not smart enough to understand it, nor do I have the time to even try to figure out what it is. And there are a lot of proponents of it that will, like you're hesitant to say it, because there's so much of a community around it, that as soon as there's a naysayer about crypto, they try to jump on it and make it seem like we don't know what we're talking about. And I, for one, I will fully admit I don't know what I'm talking about. I don't understand the environment and this built world that involves all of crypto. I don't get it. So there are.
I would just further add, that's a problem. You're probably a pretty smart guy, Chad. I hope I'm a fairly smart guy. And if it can't be simply described to us without this elaborate over-engineering, sounds like the rules of Dungeons and Dragons or something. It's, layer upon layer of things that are intertwined. That scares me. I think my team's probably tired of me sharing this quote, but there's an Einstein quote, something along the lines of genius is taking the complex and making it simple, not the other way around. And if it can't be simply articulated and described, that scares me a little bit.
Yeah, it scares me too. And the other thing that bothers me about crypto, and you can disagree with me in the comments below. I'm open to any type of criticism, but the one thing that's really bothered me with crypto is how some people have gotten very, very wealthy by gambling. And in the infancy of any technology like this, I think there has to be an acknowledgement that there's an element of gambling. And there's some people that got so wealthy so quickly by speculating, and they can call it investing if they want, and I won't argue with it, but they got so wealthy so quickly that it's taken away that the need for people to work, and commit time to, like you went and got your Bachelor of Science, I believe, in finance. Then you got your MBA. You've worked away in your industry, becoming an expert in this craft for many, many years to earn a good living. Whereas some of these people did it in the matter of weeks or months. They earned a lifetime worth of salary. And to me, that just doesn't seem like a good business model to be banking on. Anytime that somebody converts risk into that astronomical of a return, and they think that they can keep having 20, 30, 200 time returns, that to me is a very scary model to be banking on, because you just can't have exponential growth all the time. So
Yeah.
yeah, for all those reasons, I that's why I decided to get out. Is I just didn't understand it. It seemed to be too much hype, uh idealization. What was the word? How did you describe it? I thought that was really, really good.
I don't know. I don't know.
Ideologically, I'll have to listen back to it, because I in addition to the clicks and mortar, which I'm stealing, I liked how you described that as well. But I mean, we're not crypto guys. We're in the real estate space, and
Yeah,
uh,
and by the way, and sorry to interrupt, I know we're running over a little bit. For some people, it might make sense. There's people plenty smarter than me who do just fine in it, and I'm supportive of that. I don't have any problem with it. It's just not for me. I don't get it, and what I'm scared about is seems like there's a lot of retail money that went into it because it felt kind of like a get rich quick investment. And I think right now we're going to see retail money suffer and layoffs, and it's getting harder to buy goods and services and homes. And I think it's going to contribute to some tough times for us. Maybe not significantly, but those people who played in that space who are now looking at different account balances, that's tough. I feel for them, and I don't know. Hopefully, they're right in the end for their own benefit, but it's just not for me.
yeah, not for me either. I've never been one to follow those get rich schemes. I'm by nature of being in commercial real estate, I'm get rich slow. Like, it's like I've got a 20-year outlook for some of my money, versus trying to double it in 2 months in a risky new crypto. So I'm on the same page with you, and it sounds like others are as well. I know Kyra mentioned that she's with us on crypto. Again, if you have something that you want to counter, put it in the chat. I'm open to hear all sides of the dialogue. I don't have a crystal ball on any of this stuff. I just try to make the best decisions with information I have available right now, and that's why I love talking to guys like you, Eliza. I just love hearing your opinion on these different types of things, and whether we agree or disagree on certain things, just having a respectful dialogue, I think, is just important to go forward. Uh,
I agree. Eyes
yeah,
wide open. Everybody has an open invitation to call me and educate me and open my eyes, but I still can't see it yet. So I maybe the day comes along when I can, and I welcome that, and it'll make me smarter, but I'm not there yet.
yeah, no, me neither. So I do want to wrap up just talking about CREXi a little bit, because I've actually mentioned CREXi on my YouTube channel as an awesome platform for people to start looking for listings. And unlike some other software providers where there's restrictions, or you have to pay to play, there's ability to search right off the bat, and there's also the ability for people to list properties for free, with the ability to have more advanced models if you want to pay. But I'm a big fan of CREXi, so I was one of the first reasons I wanted to reach out to you, Eli, was just to thank you guys and your team for the work that you're doing. But for someone that doesn't have any knowledge of CREXi, how would you describe it? And knowing that we're over time, and I apologize, but I wanted to give you a little bit more time on that.
Oh, good. CREXi, a company I love, a team I love, really truly setting out on a mission to help bring this great industry more into the modern and eventually into the future and digitize this, great investment class, which has historically been a little clunky and slow and archaic in many ways. I grew up in the industry. I love it. So that's not an indictment, just to what I think is a mostly factual statement. So digitizing the discovery process, which is connecting supply and demand. Great world-class user experience for buyers and tenants. Same for brokers and landlords trying to lease space as well. And then we also have a world-class data product. Really, really good. We think it's priced fantastically and over delivers in value. And that's comps and stuff of that nature, ownership information, demographics, a lot of proprietary transaction activity, stuff like that. And then also online digital transaction capabilities, which in modern form has looked like an auction for the most parts. But we have a lot of interesting ways to expand from there. I'd love to connect to anyone for free demo trial periods. However, I can further introduce it, share my email and phone number with people, and I'm happy to do so. I can answer it a little more if you'd like. I don't know how deep you want me to go.
No, I'm like, this isn't sponsored by any means, but like I said, I'm just a big fan of what you guys have done, because there's other companies out there that don't take that customer centric approach. In fact, there's others that try to increasingly charge you more money, whereas I think your guys's outlook is, how can we provide more value? So I'm a big fan of CREXi. I recommend it whenever anyone's asking where they can start, if they're in a different market than me, where they can start looking for properties. I send them your way all the time, just as a great place to start that search. So what I'll do is I'll put your LinkedIn in the comments, Eli, and then if you want to add anything else in there for comments on how people can get in touch with you, I just encourage them to reach out and have that conversation.
Cool. Yeah, I just want to echo what you say. Very customer centric. That's just crucial to us. This is a people business, and we want to arm people with great technology. No disintermediation theories of trying to replace people with robots. We understand commercial real estate as a human industry, but deals still take 6 to 9 months. Why not 6 months and then 3 months, and start making people faster, creating a more liquid environment, and arming people with digital tools that they have in other facets of their life. Seems like a pretty simple thesis to us, and we're just executing on that vision.
Yeah, I'd love to see you guys keep growing. I think what you're offering is unique in the marketplace of trying to maximize profit. I think you guys are trying to maximize value, and that's something that I just believe in. That's kind of the thesis of my YouTube journey here, is just providing value. So I think that what you guys stand for and what you bring to the market is important. So hope you guys keep growing. I hope people can reach out to you and continue that conversation, because I really do think you guys need to start taking more market share.
Thanks. Yeah, we're slugging away. We're really busy. Growth has been fantastic. So we're out there fighting and clawing every day to build a great business.
Okay, well, I'll keep spreading the good word on my end. You've got my
Please
commitment
do.
on that.
Please do.
Well, thanks to everybody that joined in live, or if you're watching this after, we really appreciate you just tuning in. Thanks for all the comments and the discussion in the chat. It means a lot. If you could hit that like button if you got any value from this, I'd really appreciate it as well. And Eli, thanks so much again for joining me on the show.
Chad, thanks so much. Talk soon.
Talk soon. Bye.